Paul, thank you so much for joining us here at IMpower FundForum. Great to have you in our studio. And you've also been appearing on stage. You're talking in a panel today focused on private credit. It's something we're hearing lots of conversations around at the moment, and that move towards those private markets, looking at different opportunities in this tricky market we're in. What are you seeing in terms of private credit, and what are people having conversations with you about at the moment?
Yeah, no, it's a good question. I think, look, private credit has obviously evolved a lot, and it's been very topical in the context of private wealth now, because obviously it has been very much an institutional asset class, and that's obviously gone through its growth phase from being a very sort of small allocation out of a fixed income or a private equity allocation to now being a fully fledged allocation bucket from the institutions. And now we're seeing this evolution going into private wealth. And, you know, obviously we're very positive around that, and there are lots of advantages and attractions to the asset class.
What would you say are the key drivers for that move at the moment? You talked there about the sort of shift in focus to private markets generally. That is a trend we're seeing. There's an opportunity there. The data supports it.
Yeah.
You know, is that something that you're seeing that's not just a reaction to current market environment?
Look, I think it's fundamentally the attractions that the asset class provides, you know, and those from a private credit perspective are several, you know, being that the overall risk-adjusted return is very attractive, especially you put that in the context of public markets. I think we've seen very stable returns in private credit that have typically outperformed public markets by about 200 basis points. It's investor demand for yield. You know, we've gone through a period of very low interest rates, investors are hungry for yield, especially in the pensions world. And now that obviously can translate into the private wealth universe. You know, in private credit, it is a floating rate instrument with a margin, with a fee, and that is generating some very attractive returns. To that point around the floating rate perspective, it is a natural inflation hedge because those rates move up and down as base rates move. It's a diversification tool. It's very accretive to people's overall portfolios. You know, it's quite a conservative asset class. You know, we've been seen to I suppose, outperform the public markets in the context of lower default rates and lower loss ratios. So in addition to actually generating a great return, we also think it's a very sort of low risk approach to investing as well.
So how would you characterise those supply and demand characteristics that you're seeing at the moment, and how does that play into the broader picture? Because you know, you've talked about the opportunities with private credit there. You know, is it sort of just the market? Is it geographically kind of influenced? What are the other factors that play into it that?
Yeah, I think the supply demand dynamic is quite a clear one, especially in Europe. You know, ultimately the banks had to retrench after the great financial crisis. That is the genesis of the asset class. So after increased banking regulation, the banks were no longer to go in and finance the sort of private equity backed middle market, which is where alternative lenders have come in and stepped in like ourselves. You know, in addition to that, we've seen the increased demand for yield from investors. And then also, you know, we are servicing the private equity community more or less. So it's private equity sponsors who have seen that private credit has proven itself to be a reliable and significant source of capital, and helps them with their tool set, let's say, or their playbook of acquisitions, growing their private equity portfolio companies with multiple rounds of financing. And so private credit is a very dependable source of financing rather than the banks.
How do you think it's viewed in liquidity terms as an asset class? Because obviously, you know, there is a spread and there's a view on sort of how liquid or illiquid each of those are. Where does it sit in that picture?
Sure. So look, to date, our portfolios have been in closed-ended structures, and very much our investor base has been institutions, so pension funds, insurance companies, sovereign wealth and the like, and they've been in drawdown vehicles that might have a 7-8 year life. We've now evolved those structures to be what we call semi-liquid or contingent liquidity, which have more of a sort of quarterly liquidity timeframe with monthly subscriptions. I think there still needs to be caution. It's still, you know, the underlying assets are still illiquid bilateral loans. There is a liquidity bucket in the structures that we put together. We're just effectively trying to give different access points to different investor bases in these structures, which is still benefiting from the underlying origination engine of all the loans that we do, and which has been, you know, a growing institutional asset.
It sounds like a really exciting time to be in this industry. In those terms, you're kind of creating those new structures. It's very rapidly evolving, more so than it has in the past 2 decades, arguably, because of the market environment as well. How exciting is it for you to be at the forefront of that at the moment? And is it good to be in a forum like this where you're with your peers to discuss those challenges and opportunities?
Absolutely. Look, it is exciting. I think there is a buzz around the forum here today around sort of getting access to private markets, and certainly from a credit perspective, I think, you know, we have a lot to offer. There is a structural shift in the market whereby it is growing. Private equity demand is there, M&A activities are picking up. There's modest macroeconomic sort of growth in Europe, but we're still very positive on that, and we will be looking to build portfolios that are, like I say, very diverse and still generating a great return for our investors. But I think there's also got to be a bit of caution. There's a lot of education that needs to be done with a lot of the private wealth community. It's still very early days for a lot of them getting into these asset classes, and we've got to work hand in hand with them to make sure that they understand the asset class, the structures that we're offering them, and also how it fits into portfolios more broadly. But yes, I think it is an exciting time.
Hard but interesting work ahead by the sound of it. Paul, thank you so much for sharing your insights. Great to have you in our studio.
Thank you.